Hi and welcome. This video is about loan modifications. Now, a loan modification is a change to the original terms of the note that the borrower is paying on. And usually, before the bank will give a loan modification, there's usually some temporary hardship that they're trying to resolve. For example, if somebody lost their job and they had a big loss in their income and they're behind in all their bills, but now they're working again, well, that's a perfect opportunity for the bank to approve a loan modification because it'll help the homeowner get back on their feet. Now, loan modifications usually are only temporary reductions in the terms. For example, if you have an interest rate of 7% and you just can't afford that anymore, they might reduce you down to 6 or 5 or 4 or 3. I think they're going as low as about 2%. The other thing that they're doing is to make the payments cheaper, they're extending out the loan term to 40 years. Now, that's a long time to be paying a mortgage, but it might be worth it for you. We don't suggest loan modifications to resolve problems of equity. If you owe more than the house is worth, a loan mod won't solve that. It's really more for temporary affordability issues. Now, what banks are doing is they're contacting homeowners. In California, before a homeowner can be foreclosed upon, the bank is required to attempt to contact them to discuss alternatives to foreclosure. And this is one of the primary methods that they are pursuing. And in a lot of cases it works out much better for the bank, for reasons you'll see. Hopefully the homeowner and the banks are having conversations about what the homeowner can afford. What we're finding, though, is that in a lot of cases homeowners are agreeing to loan modifications that they simply can't afford. And this is really a big problem for homeowners here in California, especially because the housing prices are much higher in California than in the rest of the nation. For example, there's a agency that rates the banks. They're called Fitch, F-I-T-C-H. So the Fitch rating agency did a report, and actually they've done a couple of these reports. And in the latest one, what they said is that the average payment on a loan modification is 64% of the homeowner's pre-tax income. So now if you take their pre-tax income and subtract taxes, there's not much left, but 64% of the pre-tax income is being used for these house payments. So these are really high house payments. What the banks tend to be doing is put all the back fees and the penalties and the back interest, they're rolling it back into the loan, and they're amortizing it over 40 years. And in a good 35% of the cases, the payments are actually going up because there's just too much fees. And the banks have shown that they're really largely unwilling to forgive a lot of these fees and penalties and interest, which is unfortunate because that was the whole intent of, the stimulus funds was to help out the homeowners, but the banks are taking that into profits, and they're not giving much to the homeowners these days. Well, we have a workaround. We have a way to get the banks to offer you something, and we'll talk about that in the short sale video. Now, the bank wants to avoid as much direct losses as possible, and they do it with loan modifications. Now, if you think about it, if the bank were to foreclose on you, they would have to pay, I think the average is about $65,000 in legal costs, holding costs, selling costs, in order to foreclose and resell the property to another homeowner. So that's a pretty big cost. But when you consider the alternative of a loan modification, they're not willing to split that with you. And that's the most difficult part about the loan modification process. In fact, only a very, very low percentage of loan modification applications are being approved. So if you want to consider loan modification, that might be fine, but it really needs to be if you're an ideal candidate for a loan modification. So let me review that again. You're temporarily behind because of a hardship which has been resolved. You need some temporary adjustments in your payments, and probably not underwater on your mortgage. Now the bank will, especially they will give you loan modifications if you are underwater your mortgage, but it's not really helping you. In fact, the loan mods are mostly helping the banks in those scenarios, because the bank, if we were to foreclose, they would have to absorb all those losses in addition. So anyways, in the other videos we'll get more into some of those topics, but that's it for loan mods. Thank you, and I hope this helps. Oops, hi, it's me again. I did forget to say one thing about loan mods. Now, I did mention the high payments, and certainly that's a problem. And because these payments are about 64% of pre-tax income, there's a new emerging trend that's quite disturbing. These homeowners are depleting their savings, and many of them end up losing their house, and then after having depleted all their savings, now they're being required to file bankruptcy. So that's a disturbing trend. Had they done a short sale or some other option that would have helped them reduce their debt, they would have at least had what was left of their savings, and that's so important for families, because there's so many demands on our limited budgets as it is. And if we spend it all on the loan modification payments, and if it's an unaffordable payment, well, it's an obvious conclusion. So I just wanted to point that out, and that's kind of why we're here, is to kind of help people avoid those types of errors and hopefully get on a stable footing so they can do what's most important with their family budget, and that is really to take care of the children and each other